Welcome back. Previously, we were discussing about preparation of schedule of changes in working capital and case that comes under the first step. So, a fund flow statement, as I have told earlier, it's a combination of different steps. And one such step was preparation of schedule of changes in working capital, and you need to follow the order as per the steps. So, first, we will be preparing schedule of changes in working capital. Let us discuss about the further steps that comes under the statement. Next one, preparing non-current accounts. The second step in preparation of unflow statement is preparation of non-current accounts. Actually, the actual work in this step is you will be given a question in which two balance sheets of a concern will be given and you are asked to prepare a fund flow statement. Apart from those balance sheet, you will be given some additional informations. So how we are going to treat that additional information is that you need to prepare some accounts, ledger accounts on the basis of information given in the additional information given in the question. So preparing of non-current accounts means you are preparing some accounts or ledger accounts on the basis of informations given in the specific question. Some items, some specific items you need to prepare for some specific item you need to prepare accounts even though there is no information given in the question because such items are hidden. In, if those specific items is given in the question, you definitely have to prepare a ledger account even if there is no additional information given in that same question. So that is the main concept regarding preparation of non-current accounts. And this is the second step in the preparation of fund flow statement is the preparation of various non-current accounts just I have mentioned now given in the balance sheet or any additional information given in the question. This is done to ascertain the inflows or outflows of fund from non-current accounts. That's why we are preparing various ledger accounts in order to identify the flow of funds. In the preparation of non-current accounts, the general principle is that a decrease in non-current asset or increase in non-current liability results in an inflow of fund. We know that principle very well. Similarly, an increase in non-current asset or decrease in non-current liabilities result in an outflow of fund. Don't worry about this inflows and outflows. We will become very thorough with the flow of various items which we are going to deal with various items that basically specify in a question or a balance sheet. Don't worry about which all items has to be considered, which all items that has to be neglected. Don't worry about anything like that. Just understand the concept, what all things has to be remembered like that. Okay, under preparation of non-current accounts, there are different items. Means there are specific items that has to be kept in mind for which you need to prepare accounts or ledger accounts. We will discuss about the various items for which you need to prepare ledger accounts or non-current account. First one, fixed assets. Next, intangible assets. Fixed assets. Fixed asset may be given in the balance sheet at cost or at written down value. Depending upon the accounting practice followed by the company, the treatment of depreciation is different in each case. Even though the depreciation treatment may be different, but for the computation or from the examination point of view, you will be given a uniform method of depreciation. Therefore, it should be ascertained first whether fixed assets appear at the cost or at a written down value. You need to remember that. While preparing fixed asset accounts, make sure whether it is given in cost or written down value. We will discuss that part. For identifying only for identification purpose, you need to prepare various ledger accounts for fixed assets. Whenever provision for depreciation is given on the liability side of the balance sheet, fixed asset will be given at cost. Remember, whenever provision for depreciation is given on the liability side of the balance sheet, fixed asset will be at a cost. The concept is that in the balance, in the depreciation, provision for depreciation can be given in the balance sheet or as an additional information. If it is given in the balance sheet, a peculiar step has to be formed. If it is given in the additional information, another method of computation has to be made. We will discuss regarding the different computation aspects while dealing with the application level question. You just need to remember that there are specific methods or steps that has to be followed depending upon the nature of question. So when fixed assets are given at cost, the current year depreciation is credited to provision for depreciation account and not to the fixed asset account. Similarly, when an item of fixed asset is sold, the cost of such assets sold is credited to fixed asset account. And finally, when fixed assets are given at written down value in the balance sheet, current year depreciation is credited to fixed asset account. Similarly, when an item of assets sold only, the written down value of such assets sold is credited to fixed asset account. Sometimes you may find it confusing. Don't worry anything about that. We will discuss each and every individual items with regards to its additional information and additional adjustments while dealing with the application level question. We will discuss about each individual item in detail. For the time being, just informing, just explaining these all aspects has to be considered while dealing with fixed assets. So whenever you come across an item of fixed assets, an item that comes under fixed asset, remember there is a relationship between fixed assets and depreciation. In the question, if any of these two items, opening as well as closing balances are given, definitely you have to prepare an account. Just remember that. Next item, intangible assets account. We all know what is meant by intangible assets. Intangible assets mean goodwill, patent, trademark, copyright. And remember, any decrease in this account during current year should be treated as the amount written off and not as sale. Whenever there is a decrease in the value of asset, we usually consider it as sale. But in case of intangible asset, if there is decrease in intangible assets, it is not considered as a sale of asset. Instead, it is considered as a written down value of that intangible asset. Remember that. The amount written off during the current year should be added to net profit to find fund from operation. Any increase in this account may be treated as purchase of these assets during the current year for cash unless otherwise stated. Therefore, increase in assets results in outflow of fund. So remember, while dealing with the application level question, we will discuss about that in future. Whenever you come across intangible assets, remember intangible assets, when there is an increase in an intangible asset, it is considered as a purchase. But when there is a decrease in the intangible asset, it is considered as a written off in that particular asset rather than a sale. Just remember that part. We will discuss in detail in the application level cases. Next item is deferred revenue expenses. Deferred revenue expenses actually is a heading given to certain items like preliminary expenses, discount on issue of shares or debentures. So remember, whenever there is a decrease in this account, it should be treated as the amount amortized during the year, otherwise known as written off during the year. The same amount should be added to the net profit to calculate fund from operation. Next item is reserves. We all know what is meant by reserve. Reserves mainly includes general reserves, and sometimes in some situations these reserves includes capital reserves and share premium. Remember, share premium, if it is given in the question, it comes under reserves. So whenever there is an item that comes under this heading, just make sure whether there is a difference in these amounts during the first balance sheet and the second balance sheet. Any increase in capital reserves, specifically when there is an increase in capital reserve, may be due to any capital profit received during the current year. It may be due to profit on sale of investment, or profit on sale of land, or profit on revaluation of land, etc. Profit on sale is included in the sale proceeds of such assets and shown in the inflow of funds. Increase in shares or security premium account should be treated as additional premium received during the year on account of issue of shares. It is shown as an item of inflow of fund or included in the amount received from issue of shares. Next item, provision for tax. Remember, a provision for taxation and proposed dividend. These two items, even though these comes under non-current accounts heading, these two are some peculiar item because the computation for these two items are specific when compared to other non-current accounts items. Because whenever there is a provision for tax or a proposed dividend given in the question means, as I have told earlier, you will be given two balance sheets. So whenever there is a provision for tax or proposed dividend, and if the amounts of these two items are given in the question, like opening as well as closing, means it is given in both balance sheets. Remember, even if there is no additional information given in the question, you need to prepare an account. And we will discuss about how to prepare account for these two items, provision for tax and proposed dividend. These two are two individual items. Whenever you come across these two items, you need to prepare two accounts, because usually preparation of non-current accounts is depending upon the additional information in the question. But for these two items, it doesn't need any additional information. If there is these items are given in the balance sheet, you definitely have to prepare account. Remember that we will discuss that part while dealing with computation part. And regarding the provision for tax, we all know what is meant by provision for tax. Provision for tax may be given in the balance sheet and can be treated either as current liability or a non-current liability. It is treated as current liability if it is shown in the balance sheet, and if any additional information is given in the question that you need to treat the specific item as a current liability, then you have to show as an item in the schedule of changes in working capital instead of preparation of accounts. You may find it confusing why we are using the same item in two different ways. If there is any additional information given in the question, like you need to consider specific item as current liability or a current asset, whatever the nature of the item, you need to show the specific item in the first step rather than preparing non-current accounts. We will discuss that adjustment parts in the computation of problem cases. And usually provision for tax is treated as a non-current liability, and for which you will be preparing an account whenever there is an item comes in the balance sheet. We will discuss about that part in detail while dealing with the same adjustment. Next one, proposed dividend. As I have told earlier, it is the steps that has to be followed in proposed dividend is almost similar to provision for tax. Like I have said earlier, proposed dividend can be either treated as a current liability or a non-current liability. If there is no specific information given in the question, it can be treated as a non-current liability. As we all know, the term suggests dividend is proposed by the directors and declared by the shareholders at the annual general meeting by passing a simple resolution. Therefore, it is to be paid to the shareholders. Therefore, the proposed dividend for an accounting year is paid during the subsequent year. But the payment of interim dividend, sometimes you may come across an item, interim dividend, does not require such formalities. A company may pay one or more interim dividends during the year. The concept is that in the question there may be information regarding proposed dividend as well as interim dividend. So whenever you see proposed dividend, definitely you need to prepare an account. But if there is any information regarding interim dividend, you need not have to prepare any accounts. Just remember that. We will discuss further while dealing with the problem. Next one, funds from operation. That is the third step that comes under preparation of fund flow statement, funds from operation. And the concept regarding is that, as we have discussed at the beginning of this module, we are preparing fund flow statement to identify the reasons for change in the various statements, that is profit and loss account as well as balance sheet. So we, in this fund from operation, we are actually studying the actual funds that are generated through the mere operations of the business. So automatically we think that just refer to the profit and loss account, you can easily identify the profit of the business. But the thing is that the profit and loss account of a concern just depict the profit earned during that period. And during a period, the business might earn income that may not be related to the business which they are carrying out. Sometimes they, for example, if I am a businessman, I am doing some bakery business, I might earn income from different sources rather than from the sale of bakery items. I might earn income from the any rent or any commission from or any other sources. If I invest some amount in share market, I might get income from that investment. If I am investing in real estate, I might get income from that real estate business. But at the same time, I am running the bakery business. So profit and loss account shows the total income or total profit of my business or my activity during that particular period. But it does not reveal the actual profit of the business alone. So in order to identify the actual fund flow during the business or because of that particular business, you need to prepare fund from operation statement. So it is prepared to find out the fund from operation. It is a regular source of fund received from the operations of the business. It doesn't include any other activities. It is a cash operating profit of the business. So in order to find the fund from operation, there are different methods. First one is direct method, and during the computation of problem areas, you may not be using the direct method because it is quite easy. From net sales, if we deduct cost of goods sold and cash operating expenses, you will get the fund from operation. But hopefully it won't come in the examinations or any form of test papers because it is one of the easiest method. We are going to discuss about other method that will be definitely be using in the examinations. So if you deduct cost of goods sold and cash operating expenses, you will get fund from operation. But we are not going to follow this one because we are identifying the actual flow of fund on the base of profit and loss account statement. And the profit and loss account statement includes all inflows as well as outflows that are related to business and that are not related to business. So next one, second method is adjusting net profit for the year. This is a statement method, and from operation are not equal to net profit. As I have told earlier, it is a net profit before charging non-fund and non-operating expenses and losses and excluding non-operating income. The concept is that the net profit or the profit of the organization that has been shown in the profit and loss account is actually the computation after including operating as well as non-operating items. In order to identify the actual fund from operation, you need to deduct or remove all the non-operating activities, that is non-operating expenses as well as non-operating income. That is the concept of fund from operation statement. So it will be prepared like this. It begins with net profit for the year because you are preparing fund from operation on the basis of information given in the profit and loss account. That's why we are following this one. So a fund from operation begins with net profit for the year, and from that you need to add back non-operating expenses. Why we are adding back expenses? Usually we are deducting expenses, because we are trying to find the actual fund from operation of the business. And here the net profit, this amount, net profit for the year, this amount is obtained by deducting this non-operating expenses from some amount, some sort of total income or like that. So if you add back these expenses, you will get the actual fund from operation. Actually, in this statement, we are reversing what was done in the profit and loss account. In profit and loss account, we were deducting non-operating expenses. So, in order to get the actual fund from operation, you need to add back non-operating expenses. So, whatever you have done in profit and loss account statement, you will be doing the reverse of the steps which you have done in profit and loss account statement in this fund from operation. Then only you can find the actual fund from operation. So what are the non-operating expense that comes under this statement? We will discussing about some of the frequent and common items that comes under this statement. Just go through it and we will discussing about more items while dealing with various problems. First one, depreciation for the current year. We all know what is meant by depreciation, and sometimes for computation of this depreciation for the current year, you may have to prepare ledger account which we have discussed previously. Next one, provision for tax. Next one, so say loss on sale of fixed asset or investments. Next one, goodwill written off, preliminary expenses written off, transfer to reserve, proposed dividend, interim dividend. These are the common non-operating expenses items. Just go through all these items, and sometimes these items may be directly given in the question. Sometimes you need to prepare accounts, ledger accounts, as we have discussed earlier. We will discuss that in detail while dealing with the application level question. So these are some of the common non-operating expenses. Just go through it: depreciation, provision for tax, loss on sale of fixed asset or investment, goodwill written off, preliminary expenses written off, transfer to reserves. Usually it will be a general reserve item, that's why it is given in brackets. Next, proposed dividend, interim dividend. Previously we have discussed proposed dividend and interim dividend. These two items are different and the computation will be also different. For proposed dividend you need to prepare an account. For interim dividend you need not have to prepare an account. So these are the common non-operating expenses, and if we add back these items in net profit, and after that you need to deduct non-operating income. See, in the profit and loss account you were adding incomes and deducting expenses, and here we are doing the opposite. In non-operating incomes, the common item that comes are first one, profit on sale of asset or investment. See, in the expense it was loss on sale of fixed asset. So here it will be profit on sale of fixed asset or investment. Next one is dividend received. Here it was dividend paid. Here it will be dividend received. And sometimes there may be commission received or rent received, like that. That depend upon the adjustment given in the question. Finally, refund of tax. This item is not a common item. Anyway, just remember that. So by adjusting all these items, finally you will get fund from operation. So today we have discussed the second step and the third step, that is preparation of non-current accounts and fund from operation statement. And remember, for preparation of fund from operation you need to prepare various accounts. That depends upon the details given in the question. So remember these two areas. Try to familiarize all these items. We will discuss further in the coming classes. That's all today. Thank you.